Everyone's buying tech again. Apple just hit another record high. Tesla's stock is swinging before earnings, and the Nasdaq is climbing like it's 2021 all over again. If you scroll through Reddit or watch financial TikTok right now, you'll see the same sentiment. AI is the future. Don't miss out. But here's the thing nobody seems to be talking about. Behind all the excitement and FOMO, there are a few warning signs quietly flashing red. And if you ignore them, you might end up buying at the top. Again, in today's video, we're going to break down what's really driving this tech rally. And more importantly, the 3 hidden risks that most investors are completely overlooking. I'll show you why profits aren't matching prices, what smart money is doing behind the scenes, and how macroeconomic pressure could turn this rally into a correction faster than most people expect. By the end of this video, you'll not only understand what's fueling the hype, but also how to protect yourself from it. Because making money in the market isn't about chasing the next big thing. It's about seeing what others miss. This is Mindset for Wealth, where we help you think smarter about money, investing, and financial freedom. If you enjoy content that goes beyond the headlines, make sure to hit that subscribe button and turn on notifications because we drop videos that help you navigate the real world of finance every single week. All right, let's get into it. Let's start with what's actually happening in the market right now. The Nasdaq just hit its highest level since late 2021. The Dow is also pushing record territory. And it's not because the economy suddenly turned around overnight. It's because investors are flooding back into the same names that fueled the last bull run: Apple, Alphabet, Tesla, and Netflix. Apple's stock has climbed to a new all-time high after unveiling its next-generation AI-integrated devices, the iPhone 17 and the latest line of Macs. Alphabet surprised Wall Street with record profits from Google Cloud, while Tesla is once again front and center ahead of its Q3 earnings report. Even Netflix, after months of stagnation, is up thanks to its new ad-supported model and lower-cost subscription tiers. So on the surface, it feels like optimism is back. Gold prices have fallen, risk appetite has returned, and investors are talking about AI like it's the second coming of the internet. But here's what's interesting. This sudden surge in confidence isn't being matched by real improvements in fundamentals. Corporate earnings have improved slightly, but not nearly enough to justify the massive jump in valuations we're seeing. The S&P's average price-to-earnings ratio is sitting well above historical norms, and retail investors are once again leading the charge. In other words, this rally looks less like a comeback and more like a comeback driven by emotion. When gold drops and tech stocks skyrocket at the same time, it usually means people are shifting from safety to risk, not because the data supports it, but because they're afraid of missing out. And that's where the danger starts. Because beneath all this enthusiasm, there are a few signals that smart investors are quietly paying attention to. Signals that could decide who profits from this rally and who gets left holding the bag. Here's the first red flag that almost nobody's talking about. Profits aren't keeping up with stock prices. Let's take Apple as an example. The company's market cap recently passed $3.8 trillion, yet its most recent quarterly earnings were up only about 8% year over year. That's solid growth, but nowhere near the 30% surge in stock price we've seen over the same period. Alphabet? Up more than 25% this year, but its core advertising business is still growing in the single digits. Even Tesla, which everyone's watching, has seen its margins fall as competition heats up and price cuts eat into profits. So, what's really pushing these stocks higher? It's not fundamentals. It's expectations. Investors are pricing in massive future gains from artificial intelligence, automation, and innovation that haven't materialized yet. It's the same mindset we saw back in 2021, people buying based on what they hope will happen, not what's actually happening. Here's why that's dangerous. When prices move faster than earnings, valuations expand. And when valuations expand too much, it doesn't take bad news to crash a stock. It only takes less good news. We saw this before with companies like Zoom, Peloton, and even Meta during the last tech boom. Stocks that were too good to fail dropped 50 to 70% in a matter of months when reality caught up. Now, I'm not saying Apple or Tesla are doomed. These are world-class businesses. But the pattern we're seeing, the gap between earnings growth and price growth, is unsustainable long-term. It's like a rubber band. The further it stretches, the more violent the snap when it corrects. So before buying into this rally, ask yourself one thing. Are you investing in what's real or what's hyped? Because in every market cycle, those two lines eventually meet. And when they do, the truth tends to hit hard. Now let's talk about the second warning sign. And this one's a little uncomfortable. While retail investors are piling into tech stocks like it's a guaranteed win, smart money is quietly stepping back. According to recent fund flow data, large institutional investors, the hedge funds, pension funds, and mutual funds that manage billions, have been reducing their exposure to big tech over the last few weeks. Meanwhile, retail traders are doing the exact opposite. Platforms like Robinhood and Fidelity are seeing record inflows into names like Apple, Nvidia, and Tesla. So what does that tell us? It means that the pros are selling strength and the public is buying hype. Here's a quick example. During the last 2 months, ETF reports showed that money has been flowing out of the Invesco QQQ Trust, which tracks the Nasdaq's biggest tech companies, even while those stocks have been rising. In other words, prices are going up while smart money is exiting. That's not necessarily a crash signal by itself, but historically, this kind of divergence is a red flag. We saw the same thing in late 2021, just before the market rolled over. Retail investors were convinced that stocks only go up, while institutions were quietly hedging and reallocating to safer assets. The reason smart money acts this way is simple. They follow data, not emotion. They know when valuations stretch too far. They understand that a small earnings miss or one hawkish Fed comment can flip sentiment overnight. And here's the hard truth. Most retail traders don't. They chase what's moving, not what's sustainable. So, if you find yourself feeling that itch to buy just because everyone else is, pause for a second. Ask yourself, if the professionals are getting cautious, what do they see that I don't? Because in markets, it's not the crowd that wins. It's the calm investor who understands when the crowd has gone too far. Now let's look at the third warning sign, and it's a big one. The broader economy hasn't caught up with the optimism we're seeing in the market. Yes, stocks are up. Yes, inflation has cooled slightly. But underneath the surface, there's still a lot of pressure. Interest rates remain at their highest levels in more than 2 decades. Credit card debt in the US has hit an all-time high, over $1.3 trillion, and delinquency rates are starting to rise again. Meanwhile, wage growth is slowing, and consumer savings from the pandemic era are nearly gone. So, what does that mean? It means this rally is happening at a time when the real economy is still struggling. Consumers are stretched thin, small businesses are paying more for loans, and the housing market remains locked by high mortgage rates. Yet, investors are acting like we're heading into another golden age of growth. Even global central bankers are sounding cautious. Just this week, the Bank of England's governor warned that parts of the US private credit market are showing worrying echoes of the 2008 financial crisis. That doesn't mean a collapse is imminent, but it's a reminder that risk hasn't disappeared. It's just been repackaged. When markets rally while the economy is slowing, history tells us that something eventually has to give. Either earnings rise to justify prices, or prices fall to meet reality. Right now, it looks like investors are betting on the first option, but the fundamentals are leaning toward the second. So if you're investing today, keep this in mind. Optimism makes money in bull markets, but realism saves you when they end. So let's recap what we've learned. Everyone's buying tech again, but beneath the excitement, 3 red flags are flashing. Profits that don't match prices, smart money quietly exiting, and a real economy still under strain. Now, that doesn't mean you should panic or sell everything. The point isn't to be fearful, it's to be informed. When you understand what's driving the market, you make smarter decisions. You stop chasing hype and start thinking like an investor, not a speculator. Remember this, the people who make the most money in markets aren't the ones who move first. They're the ones who understand why they're moving. Right now, the market is running on excitement, not evidence. So stay patient, stay rational, and focus on companies that create real value, not just real headlines. If you found this video helpful, make sure to subscribe to Mindset for Wealth for more deep dives into what's really happening behind the markets. We post every week, helping you see the patterns others miss and think differently about wealth, money, and financial freedom. Thanks for watching, and I'll see you in the next video.